Welcome to the recorded session of our speed dating with not-for-profit specialists. Not-for-profit experts within Hanrick Curran have teamed up with other corporations with a specialisation in the not-for-profit sector to bring charities and associations information to reduce tax and risk, increase revenue opportunities, and improve your corporate governance. During the course of this recording, you will hear from our lineup of specialists who will impart some short, sharp insights for you to apply in your organisation. Enjoy the session.
Philanthropy Australia is the national peak body for growing giving in Australia. Our role is to encourage the planned and structured giving of time, information, goods and services, as well as money. We're a membership organisation, so philanthropists are our main members, and not-for-profits can be involved as associate members. What does that mean for you? Networking opportunities with philanthropists, of course, being at the forefront of best practice and thought leadership, and access to data and resources. We run an excellent policy and an advocacy program, and lots of opportunities for education and professional development. People often ask about the history of philanthropy in Australia. The earliest known not-for-profit is the Benevolent Society, established in the 1820s in Sydney, and the earliest foundation is the Wyatt Benevolent Trust in Adelaide in 1881. The Felton Bequest from 1904 has been the biggest contributor of artwork to the National Gallery of Victoria and is still very significant. We also hear about philanthropy being strong in Melbourne. One of the reasons for that is between 1910 and 1970, they had death duties. So when you died, 60% of your estate went to probate duties unless you set up a charitable trust to benefit Victorians. In Queensland, Joh Bjelke-Petersen actually abolished death duties, so we were the first to head in a different direction. Philanthropy Australia was established 30 years ago from some of the big foundations in Melbourne, the Ian Potter Foundation and the Myer Foundation, and since then we've been working in this space. But the next most recent event in philanthropy was the arrival of the private ancillary funds, or at the time, the private prescribed fund. There are 1,200 private ancillary funds in Australia, and we understand there to be about 110, 120 or so in Queensland. But one of the important things to note about philanthropy is that people are philanthropic because of their values, but tax is why you might be philanthropic today rather than put it off. How does Queensland compare in those figures? We have 14% of the wealth in Queensland, but only 11% of the private ancillary funds. So that's a really important figure to understand, that there's room for growth, 14% of the wealth and 11% of the private ancillary funds. There are some who are very well known and public, like the Tim Fairfax Family Foundation, who have a website and people know what they fund, through to some with obscure names that can't even be traced. There's one foundation where the family name is spelt backwards as a way of being a bit more incognito. And there's some amazing leadership in Queensland in the philanthropy field. People like Alan English, who is the Philanthropy Australia Inaugural Philanthropist of the Year this year. And you'll know big names like Berghofer, Feeney, Main and Marchant, who have all made significant contributions to Queensland's philanthropy. The role of not-for-profits is obviously to encourage the philanthropists that support your organisation to be public so they can inspire others. People often ask, how do we compare to America? And the common question is, Australia is on the second run of giving, and that's because we have a strong government safety net, and history suggests that philanthropy runs inversely proportional to the government safety net. Also, it's about comparing statistics. In the US, money given in church plates it constitutes 30% of their giving and is tax deductible, as is putting clothes in charity bins, giving to schools and giving to hospitals, whereas in Australia that's not the case. It's also about comparing apples with apples. Australians are generous, but probably more so as volunteers. When the article in the second half of the slide talks about Australians being ranked as the most generous in the world, based on a criteria around not only giving money, but volunteering and helping a stranger. So we're probably less philanthropic in terms of planned and structured giving, but definitely community-minded. This graph shows giving in Australia in the last 30 or so years, where Australians have claimed $2.3 billion in tax deductions. The blue in the graph indicates when private ancillary funds, as mentioned before, were introduced. And you can see that the philanthropy has continued to grow despite the introduction of PAFs. Sometimes there is a concern among charities that that money might be being locked up, for example, but it's not at all the case, and we can see philanthropy has continued to grow. In Queensland particularly, it's worth looking at the trends. In the 2011-2012 figures, the average amount that the average Australian claims in tax deductions is $494. Queenslanders only claim about $370, so we probably have a little ways to go. For fundraisers out there, however, you can search by postcode to see which suburbs are the most generous, and for those in St Lucia in Queensland average just over $4,000 a year in tax deductible giving. So it is worth using the QUT postcode finder tool, which is on the fact sheet. There are some critical things that the philanthropic sector want the not-for-profit sector to be thinking about. The first of which is that there are 600,000 not-for-profits in Australia. Now, people often try and correct me when I say that number, but it is 600,000 not-for-profits. So there is huge concern about duplication or ineffective use of resources. So one of the first things that not-for-profits need to have at the forefront at all times is measuring their impact and using data to better track that duplication. There's also huge scope for collaboration and ultimately mergers and acquisitions in the sector, and the philanthropic sector look very favourably on that kind of thinking. Another area that's a huge trend, a growing trend at the moment, is the growth of the social enterprise, looking at monetising or finding ways to make money to contribute back into the charitable work of your organisation. In philanthropy, especially in Queensland, that are worth having on your radar, one of the key ones is that recognition that everybody can and does give, not just the wealthy. And that's an important story to tell in Queensland, where I think we sometimes have a bit of a chip on our shoulder about who should be doing the giving. One of the new approaches to giving is giving circles, and a great example is Women and Change, which is the Queensland Women Giving Circle, in which 55 women have all given $1,000, and not-for-profits will be shortlisted, and the women will vote on the top 3 not-for-profits, and one of those not-for-profits will receive a transformational grant of $55,000. Also worth keeping an eye on is the growth of impact investing and social finance, with things like no-interest loans and social impact bonds are growing in popularity with government and the not-for-profit sector. And finally, corporate engagement, corporate giving, workplace giving, and closing the gap between the not-for-profit and corporate approaches. So really that encouragement and enthusiasm for a more business-like approach. For further information on Philanthropy Australia, I encourage you to go to our website, where we have extensive resources and information on our various programs and an opportunity to consider membership. Please don't hesitate to get in contact.
Hello, I'll be talking to you about tax-efficient giving and bequeath strategies. And there's 2 main areas to that I want to talk about. The first is an understanding of what can be claimed as a tax-deductible gift inter vivos, so while living. Then the second will be talking about deceased estates and how a testator can create a tax-efficient will and the directions that a charity can provide them. So by having an understanding of these issues, you should be able to produce strategies to attract further donations. Okay, for tax-efficient giving, we'll be talking about what can be claimed as a tax-deductible gift while living. So there's 3 main areas to that. The first is gifting money. So as most people would understand, donations of $2 or more to a deductible gift recipient are able to be claimed as tax deductions. There's also other kinds of gifts, so gifting property or assets in kind. And then the third type of gift is gifting as part of a fundraising event ticket price. This slide demonstrates the amount of a tax deduction that can be claimed for gifts to deductible gift recipients. The first line is money, and the deduction is the amount of the money spent, provided it is more than $2. The second line looks at property that has been purchased within the last 12 months. Now the deduction is the lesser of the market value of that property and the cost to the donator. The third line is looking at trading stock. So if you're in a business and have trading stock and you gift that to a charity, that's being disposed outside of the ordinary course of business. If you don't make an election for that, you can claim a tax deduction equal to the market value of that trading stock. Next, we'll look at property that's valued at more than $5,000 and has been purchased more than 12 months ago. In this situation, the donator actually has to go to the Commissioner of Taxation and apply for a valuation. And whatever the Commissioner agrees is the value, you'll be allowed to claim a tax deduction for. Next, we'll look at listed shares that are valued at less than $5,000 and purchased more than 12 months ago. The amount of deduction is just the market value on the date of the donation of the shares. Now finally, we will look at fundraising tickets where the ticket price is more than $150. So let's say, for example, you attend a charity event that's costs $2,000 for a ticket price. But the actual market value of the fundraising event, so the food and the drinks, is only $100. You can actually claim a tax deduction for that fundraising event of $1,900, so being the $2,000 ticket price less the $100 value of the dinner. Now this is only allowed where the value of the dinner is less than $150 and it's less than 20% of the overall cost of the ticket. Next, we will focus on bequeath strategies with a major focus of estate planning and how to reduce the tax on the estate. So we'll look at understanding how deceased estates are taxed. We'll look at why it's good to have charities as residuary beneficiaries to ensure the income of the estate can flow to them. And we'll need to ensure that executors and tax agents prepare estate tax returns in the most efficient manner. So it's good for everybody to have an understanding of the taxation of the deceased estate. Under a deceased estate, it's important to understand how the estate is taxed. Now, one of the major focuses of estates is the disposal of assets. Now, that can either occur through the sale by the executor or by the passing of the assets under the legacy and the will. Now, it's important to understand that where assets pass under the will, there is no capital gain or no capital gains tax applying to that transfer to the beneficiary. However, if the executor sells an asset to pay for liabilities, then the estate will realise a capital gain and will generate income. Now, the estate is actually taxed on the income if there are no beneficiaries that are entitled to the income of the estate, and that depends on the timing of where the executors are at in the administration of the estate. However, if you're at a point in time where all liabilities have been ascertained and provided for and income isn't required to pay for any of those liabilities, the estate is taken to be administered to a point in time such that the residuary beneficiaries are actually beneficially entitled to the income, and therefore the estate isn't taxed, but the underlying beneficiaries are subject to tax on that income. So some strategies to consider for testators is to gift tax inefficient assets to charities, and specifically to those charities that are deductible gift recipients. Now, the reason for that is if you've got an asset that's got a very low cost base and a high market value, if that were passed on to an individual and that individual then sold that asset, well, they personally would have a large tax bill. However, if cash were given to the individual and there's no tax on that, and then the specific asset was instead given to a deductible gift recipient that's an exempt entity, well, then there's no tax on the disposal of that asset. The next strategy is to make charities as residuary beneficiaries of the estate. So what I mean by that is having specific donations to, the family members, and then the remainder of the estate is gifted to charitable beneficiaries. Now, the reason why that is tax efficient is if there is income flowing through the estate and the charitable beneficiaries become presently entitled to that income, because they are exempt entities, then there's no tax on that income. Now finally, under the bequeath strategies, I think that the key to minimising the tax under an estate and having tax efficiency is ensuring that the testator, the executor, and the tax agent who's preparing the estate returns all understand the tax issues for the estates. So the testator understands them and prepares the will on the basis that the giving is the most tax efficient. And then by having the executor and the tax agent understanding that and understanding what can occur under an estate tax return, they can then realise those tax efficiencies through the administration of the estate and the preparation of the return. So I guess a key takeout for charities is to try to educate testators about some of these issues. And as part of that, we've got a comprehensive guide to testators, executors and not-for-profits on efficient estate giving. So if you'd like a copy of that, I encourage you to contact me. Now finally, just to talk about some things that I've been doing with various estates. We've been actually going back and reviewing tax returns where charities are the beneficiaries and the estate has actually paid tax. So what we've been doing is having a look at those returns and objecting to the tax assessment, and in some cases we've been able to get money back because the tax return wasn't prepared correctly, and where the money has been flowing through to those charitable beneficiaries, we've been able to get a substantial amount of money back. So there's opportunities for charities to consider that strategy, talk to executors, and if returns have been prepared incorrectly, there is a review opportunity available, and I'm very happy to assist with that. So please come and talk to me about it later on. Thank you.
The vision for Westpac is encapsulated in one word really, and that's helping. Helping our customers and our communities prosper and grow. We're really proud to be Australia's oldest company and will celebrate 200 years in April 2017. And we realise that being such a big company, our success is based on the success of the people, and the organisations and the communities that we help. And nowhere is this more relevant than in our social sector business. One of the things that we're most proud of is the Westpac Foundation, where the rubber really hits the road for us. It's our direct commitment to community organisations that are helping the most disadvantaged people in our communities. Our community grants empower local leaders in Westpac to support not-for-profit organisations that are making that difference locally. In 2013, we donated nearly $600,000 to 58 organisations. In Queensland, this included well-known names like the Daniel Morcombe Foundation, all the way to small organisations like the Toowoomba Clubhouse, who assist adults with mental illness to develop the skills and confidence necessary to live satisfying and productive lives. We're also really excited that as part of celebrating our 200 years, we'll make up to 20 scholarships a year available for community leaders. And that's not just in 1 year, that's in perpetuity, as part of a $100 million investment through our Bicentennial Foundation. In the context of providing you some help today, there are 3 interrelated things that I wanted to talk to you about. How do you deal with digital disruption? What technology can mean for the operational efficiency of your organisation? And ensuring that you're managing the key risks, particularly credit card data. One of the topics that almost invariably comes up across the spectrum of businesses that we talk to is this phenomenon known as digital disruption. It's commonly accepted that we're living in an unprecedented time of disruption. We've got more ways than ever before to separate consumers from their money, and therefore we've got more organisations that are trying to do that. And whilst this is a global evolution, There's no place where it's been felt more than in Australia. We're at the vanguard of digital disruption in payments. The global consulting firm WorldPay recently released their report on the digital economies of 42 leading countries. It found that smartphone penetration in Australia was ranked third behind only Sweden and Singapore. We had the largest compound annual growth rate of e-commerce payments of any developed country over the last 4 years. And we lead the world in the adoption of contactless payments. So even by global standards, this is a market standout in the context of that digital disruption. The disrupted consumer of today not only has plenty of choice when it comes to where they direct their dollar, but they're equally time poor and they're demanding not just convenience, but an experience. In the age of the informed consumer, organisations need to be advertising and engaging with their clients in an online environment. For social sector organisations that have got the ability to do it, it's great. But the danger we see is that for some organisations, their focus is on the interaction through social media and online without thinking about the transaction. And this can mean an increase in operating costs without generating any additional revenue. Those organisations that can shorten the distance for consumers between the interaction and the transaction will have a competitive advantage with the disrupted consumer. We know that for not-for-profits, there's a constant battle to keep front of mind with potential donators. The opportunities across payment options are many and varied. Our advice would be to ensure that in focusing on the challenge to stay front of mind, you're also getting more donations. Having a seamless transition between interaction and transaction is critical. A lot of what we do in our specialist banking team is very much about creating efficiency in an organisation through good financial solutions. One of the most common challenges we see growing and successful organisations face is pretty fundamental. How do I grow my organisation's income quicker than I grow my cost base? We often find that the systems and processes a growing organisation is using are more reflective of them as they were before they started growing. And as they got into a growth cycle, they were flat out trying to continue to grow without really thinking about the opportunities to lower cost and streamline their processes. You might have heard the phrase that someone is sitting in the shade today because someone planted a tree a long time ago. It certainly resonates across the work that social sector organisations do. And in the quickly evolving and digitally disrupted world, what trees are you planting now to ensure that you have shade for years to come? I'll cite the example of a community organisation. They turn over about $1 million a year, they employ a few people and they rent an office, the usual kind of stuff. This year, they did 3 key but importantly related things. They went from a hardware-based to a cloud-based system, removing all those boxes and wires from their office. They migrated from a license-based accounting package to a web-based solution. And they worked with us to transition a number of manual processes into electronic ones and ensure that their transaction and payment data interfaced automatically with this new systems. The result of all this was a reduction in their operating cost of $80,000 a year. $80,000 they were able to redirect to their core mission. They planted that tree. Our advice is to look at your banking and payment processes being as much an IT opportunity as it is a financial services opportunity, ensuring that it's scalable and adaptable and takes a total view. How does your CRM talk to your accounting system? How does the accounting system integrate with your banking platform? On what data needs to go where? What can be automated but still secured? The final aspect I'd like to talk to you about is reputational risk. As community organisations, your reputation is critical. And from our perspective, there are a few things more damaging but also more avoidable than credit card fraud. Card testing is a practice used by fraudsters to test that card numbers they've stolen are still valid before the card data is used for purchases of goods that deliver them immediate value. Unfortunately, the most common victims of card testing are charities, partly because you provide no tangible goods or services, but also because your goal is to make giving as easy as possible, and this proves an attractive proposition for criminals. Sustained card testing on charity websites has become commonplace in recent times, and criminals often use technology to expedite this process. And whilst you don't lose money from card testing, there can be a significant brand damage if the testing transaction is the first fraudulent transaction that appears on a customer's account. The good news is you can take a number of steps to detect and prevent that fraud, namely deploying things like capture technology that prevent automated scripting of cards on your website. Capture is that funny code of random words that get generated on the website as you progress through a payment process. You can utilise monitoring tools that check for unusual patterns in card traffic, including increases in velocity of transactions, transactions outside of normal business hours, payments from a common IP address, payments from overseas cards. And make sure that you provide cardholders with a choice of amounts to donate. That makes it harder for scripted attacks to occur. We'd invite you to contact Westpac at any time should you like to discuss these opportunities further.
Hanrick Curran Audit are currently engaged by a significant number of not-for-profit organisations ranging in turnover from 1 to 30 million. During the course of the last 12 months, we have come across a number of common reporting issues and opportunities for these organisations. During the course of this brief presentation, I will highlight some of the more common misunderstandings surrounding the reporting requirements for charities and associations. A lot of directors and responsible officers don't take the time to sit down and consider what type of financial statements they're going to prepare. Yet this decision can have a dramatic impact both in the amount of time and the cost to the organisation from preparing financial statements. Now, whilst the difference is governed both by the Australian accounting standards and the Statement of Accounting Concepts, a lot of times the directors will simply take the advice of the auditor and not consider whether or not that advice is correct for their organisation. So in the end, it really comes down to a few questions. For example, what is the spread between ownership and membership of the not-for-profit? Does your not-for-profit have economic or political importance or influence? And is your not-for-profit large in size or have significant amounts of assets or debt or receives a lot of funding from government or other parties or has a large number of employees? The more yeses you answer to those type of factors, the more likely your not-for-profit is going to be a reporting entity and therefore need to prepare general purpose financial statements. As pointed out on the next slide, if you are a reporting entity, you're going to need to prepare general purpose financial statements that comply with all the accounting standards. However, if you are a small organisation, you will be able to take advantage of the reduced disclosure regime, which has some less detail in the reporting. If you're a non-reporting entity, then you have the ability to prepare special purpose financial statements which are going to have a lot of benefit for the organisation. So what is the impact of this decision? Well, special purpose financial statements are significantly less complex and significantly more cheaper to prepare. There is no need to adopt all the accounting standards. However, with general purpose financial statements, you're going to need to adopt all the accounting standards, and therefore the amount of time and cost to prepare will be significantly increased. People say that general purpose financial statements are seen as being more transparent and more accountable because there is so much more information that is disclosed in them. However, a lot of the cost also comes about because of the amount of accounting advice you're going to need in order to get the disclosures correct. A lot of lenders, in particular the banks, have been inserting material adverse events clauses in their loan documents for a number of periods now, or a number of years. What the clause basically says is that if there's a material adverse event, then the bank can call in the loan. However, a lot of people haven't given much consideration to what this actually means. A material adverse event, when you read the clause, is basically any event that the bank believes is materially adverse to their position. In other words, it gives the bank the right, at their own option, to recall the loan at any time. So what's the impact of that? Well, that means all your debt at the end of the day is current debt, and that's going to have significant impact on things such as your loan covenants and the position of your balance sheet, and can impact on your ability to borrow. In the area of employee benefits, there still seems to be some confusion about what constitutes either a current or a non-current classification in your balance sheet. Whilst AASB 119, the standard that deals with employee benefits, talks about whether they are described as short-term or other long-term benefits, the determining factor for whether they are a current or non-current liability is in fact AASB 101, the presentation standard. If the company has an unconditional right to defer settlement, that is, if the company has the ability to defer settlement past 12 months, then it's going to be non-current. However, if the company has an unconditional right to defer settlement, then it's going to be a non-current liability. However, if an employee has met their service qualification period, for example, they've worked more than 10 years and therefore have their long service leave owed to them, the fact that they're not going to take it in the next 12 months is irrelevant. It is classified as a current liability, but with the description of being an other long-term benefit. Now, this can have serious implications for both covenants or banking agreements or finance agreements where you have covenants within those agreements which require certain ratios for things such as your current to non-current. This can have significant impact, for example, with banking agreements where you have a requirement to have a current ratio, that is your current assets to current liabilities, at a certain rate. Whereas directors have been thinking long service leave is non-current, suddenly the standard will require these to become current liabilities and impact on that covenant. Whilst most people consider that the ACNC is now the not-for-profit regulator, there are 4 areas where you're still going to need to be contacting or dealing with ASIC. They're going to be whenever you register a company, when you wind up a company, where there's insolvency, or where you're going to raise funds. For everything else, you'll be dealing with the ACNC. From the 1st of July 2013, a lot of the requirements under the Corporations Act have been replaced by the ACNC governance standards. Now, I've listed out the 5 that have already been released. I suppose the 3 most important are Number 2, which deals with accountability to members, that is reporting and disclosure to your members. Number 4, which deals about the suitability of responsible persons, that is the director's requirements. And number 5 deals with the directors of responsible persons, that is directors' duties. Now, in comparison to the Corps Act, a lot of the ACNC governance standards are significantly more practical and more easy to implement and adopt. So this should have significant reduction in the cost of governance for a lot of not-for-profit boards. In the valuation of assets, there's 2 areas where we're seeing both delays in the audit process and additional costs being incurred. Now, the standard dealing with property, plant and equipment says that if you revalue an asset in a class, you must revalue all assets in that class. That means that you simply, if you've got a number of buildings and you want to revalue a building, you must revalue all the buildings. A lot of the times we're turning up to the audit, we find that the company has only instructed the valuer to value one building, which means that either they've got to drop the valuation for the financial statements or go out and get all the other buildings valued. That's simply a requirement of the standards, which we have no way around. The other area of confusion is around the new fair value measurement standard. It requires that the asset be revalued at its highest and best use. Now, a lot of the valuers or valuations we've come across are not adopting that valuation process. And that is meaning either the valuation can't be used or else the directors are requiring new valuations to be done or updated valuations to be done, which is again incurring significant delay and significant cost. So the key messages coming out of this are, if you're going to revalue assets, you must revalue all the assets in the class. And secondly, when you instruct your valuers, make sure you instruct them that the valuation needs to be in accordance with the new fair value measurement standard and that the asset must be valued at its highest and best use. The final area of misunderstanding that we commonly come across are to deal with capital funding arrangements. Now, these were funding and are funding arrangements that are usually granted by the state government for the purchase of land and buildings. However, we've found that there are in fact 2 types of capital funding agreements. When you read through the terms, some are repayable and some will never be repayable if the funding arrangements and conditions are met. The significance of this is that in all the capital funding agreements we've come across, the not-for-profit entity has had a liability and a significant liability sitting on their balance sheet. In the last 12 months, we've looked at 4 capital funding arrangements, of which 3 were never going to be repayable if the conditions were met. That's resulted in one instance of $3 million and 2 instances of in excess of $500,000 being immediately removed from the liability section of the balance sheet and strengthening the overall position of the not-for-profit entity.
In the presentation, we are going to discuss 3 key issues: board governance, directors and officers liability and insurance, and consolidation, which we're seeing in the sector, and the issues to consider in a merger or acquisition. With board governance, the 2 key issues which we tend to see for not-for-profits are conflicts of interest and a lack of diversity and succession planning in not-for-profit boards. With conflicts of interest, often directors are aware that they need to disclose any direct or indirect financial interest or other conflict which they have. However, practically, this is not often what occurs, and the duty isn't strictly adhered to. The issue with that is that it often puts directors in the firing line for breaches of directors' duties and also causes issues of perception for the not-for-profits. Some examples of conflicts of interest that practically come up and which we see on a day-to-day basis are, firstly, where there's 1 or 2 very strong-willed directors or members on a board, and there's been instances where they have a conflict of interest, which they then declare in accordance with the proper process. The issue arises when they stay in the meeting. So the result of that is they declare the conflict, they stay in the meeting, and then the members left in the meeting don't feel like they can frankly discuss the conflict because of the influence that that board member has. The other example, which actually comes up quite frequently, is where, particularly in smaller not-for-profits, you have members who are also employees of the organisation that sit on the board. So when you're talking about operational matters or employee matters, it's often a conflict for them to be involved, which gives rise to certain issues. The other one, which we've also experienced, is in respect of disciplinary matters. So where you have a board member who's been delegated responsibility for dealing with a particular disciplinary matter, they need to make sure there's no conflict, whether that's real or perceived. We have had instances where we've gone through a disciplinary process with the board member who was designated to look after it. And then when it came to the disciplinary meetings with the employee or member, it came to light that there was a perceived conflict with that board member and they couldn't actually attend. With disciplinary matters, that's a really critical process to get right. So conflicts of interest, even if they're perceived, need to be removed from that equation. We've also seen recently where there's perceived conflicts of interest with not-for-profits that funding bodies are actually stepping in and forcing them to be resolved because they don't want to be providing funding to organisations where there may be any possible conflict. With some general tips to deal with conflicts of interest. Firstly, if a director is unsure about whether there is a conflict, they should disclose that and err on the side of caution. They should not take part in any deliberations on the contract or matter where they have a conflict, and they should actually leave the room, and they should obviously not vote on any of those matters. Where it's a substantial conflict, the board should also consider whether that needs to be disclosed to members, which can often be done in the annual notice to members for the annual general meeting, which just details how the conflict was dealt with by the board. The second issue, which we often see with not-for-profit boards, is a lack of diversity with the members on the board and also a lack of succession planning. That's often due to a lack of resources for not-for-profit boards, and they don't have the time to put into that process. There are some key tips which boards should consider in looking at those issues. The first is with the structure of the board, to have an effective composition, size and commitment of persons on the board to ensure that the board is appropriately discharging their duties. So often when you're looking at the board, you need to ensure you have a cross-section of skills and experience, whether that's legal, sector experience or industry experience and accounting experience. They should also ensure that they admit board members so that the collective board understands the business's key issues and can exercise independent judgment so that it enhances the performance of the company and also the board. If the board doesn't have a formal nominations committee which looks at directors who are to be approached or be appointed to the board itself needs to have a process in place for selection and appointment of directors and for determining the desired competencies of directors which they need on the board to fill any vacancies. In order to assist with that process, it's recommended that boards develop a skills matrix. Essentially, it's a tool that allows you to identify what skills gaps are on the board and then create position descriptions and seek to find directors for those roles. In relation to the board size, it should be large enough so that it comprises a wide range of skills and experience, but not so large that decisions can't actually be made. So the research shows that any board over 10 people, its efficiency actually starts to decrease. With current boards, they need to actively be planning for succession, and as part of that they need to be speaking to their current board members and talking to them about how long they propose to stay on the board and stand for re-election, and then selecting early on possible replacements for those directors. Over recent years, there has been an increase. Over recent years, we have seen a consolidation in the not-for-profit sector. Essentially, that's been driven by funding cuts, which have forced organisations to amalgamate, and also a desire by governments at all levels to deal with fewer providers. There are some key issues which need to be considered at a headline level as part of any merger or acquisition. The first one which comes up and is often a critical issue is how the board of the entity which is being acquired is to be represented on the board of the continuing organisation. So, for example, is it intended that they will have half of their board members join the continuing board, or is it intended that their board will no longer exist and have no representation moving forward? That's often a key issue in negotiations. The second issue is how the members of the entity which is being acquired are to be dealt with. So are they to become members of the new organisation, or is their membership to end? The third issue, and this is critical for not-for-profits, is whether their funding arrangements are actually able to be transferred to the new organisation and therefore can continue. The other thing which that organisations need to consider is doing a thorough due diligence into the entities which are going to be merged or acquired, and also considering the cultural fit, because often with not-for-profits they can have very different cultures, and that's one of the key issues that comes up post an amalgamation or merger happening. The other issue is to consider how the merger will structurally and practically be implemented. So physical relocation of premises, assets and staff are the three key issues that need to be considered. If you have any queries or need any assistance with the matters discussed, please do not hesitate to contact me.
The purpose of this exercise today is to demonstrate how social enterprise may be used to assist not-for-profit organisations in dealing with issues related to funding. Today we'll demonstrate how the establishment of a labour hire company has assisted a client to be able to fulfil their dream of becoming self-sufficient. Stepping Stone Clubhouse is a Brisbane-based organisation which provides non-institutional settings to enable adults who have suffered from mental illness to get the support that they need to be able to rebuild their lives through rebuilding their confidence, stamina, concentration, social and vocational skills. Stepping Stone Clubhouse celebrated its 20th anniversary in the first week of October 2014. One of the largest issues, which is what I'm going to concentrate on today, is assisting people with mental illnesses get back into employment. Typically, people with mental illnesses or who have suffered from mental illness experience disproportionately high levels of unemployment. This is often as high as 85%. Generally, these people have the desire and the skills to work, but they just require the right support to successfully gain and maintain employment. Typically, the barriers to employment that members of the Stepping Stone Clubhouse have been noticed to suffer from have been anxiety, their broken work histories, as well as a stigma. A particular case that I've been involved with lately involved a young gentleman who had sent off 65 job applications to which he had not received a response due to the stigma issues that he suffered from disclosing his illness. Stepping Stone Clubhouse has been supporting people back into employment for a large part of their history and has been very successful in doing so. It is this access to employment which is the critical point in ensuring that people who have experienced these illnesses to make sure that they're fully included and integrated back in the community, and working is very often positively linked with the overall wellness and quality of life. We can therefore say it's the major goal of Stepping Stone Clubhouse to break down these barriers to provide quality employment for its members. The dilemma which has been faced recently by the Stepping Stone Clubhouse relates to the provision of employment from an organisation which is called Aftercare. Aftercare has been very generous in providing Clubhouse members transitional employment positions over the last few years. Due to an internal change in policy, members who were seeking these positions could not be contracted directly to Aftercare as employees, and therefore it meant that for people who wanted to take up these positions that they needed to basically source their own ABN, ensure that they were adequately covered from an insurance perspective, and then were required to complete the appropriate paperwork. This is reasonably similar to having to start your own small business, and typically members have enough to worry about in their day-to-day lives rather than having this burden placed on top of them also. This situation raised a couple of questions. One, do we continue along the same path, being a recipient of government assistance, or do we take matters into our own hands and become self-sufficient? After taking a lot of advice from a number of people who were situated either on the board of the Stepping Stone Clubhouse or external, we assessed that there was a number of issues which needed to be considered in establishing the enterprise. First was the physical structure and ownership of the entity, where we basically had to consider, was Stepping Stone Clubhouse Inc. an entity which could run a business, and we were required to take legal advice. In relation to this, we ended up establishing another company which was wholly owned by Stepping Stone Clubhouse, which enabled us to undertake a commercial venture. The second bit in relation to this was the establishment of contracts and the associated HR issues associated with running a labour hire company. This required us to take advice from our internal HR function as well as from external HR parties to make sure that the contracts were all legitimate and that we were contracting correctly with our members as well. The third element related to the pricing and ensuring profitability, because there was no point undertaking a venture such as this if it is going to be a further burden on the clubhouse, and we needed to ensure that this was profitable. Such activities involved Hanrick Curran undertaking pricing analysis to ensure that the venture we were undertaking was profitable and that the members would be receiving the full benefit of their wages. We also had to consider other minor matters such as insurance to ensure that we were covered from a work cover perspective, as well as for the relative professional indemnity and public liability cover, as well as that of the record keeping and the accounting function. After consideration of all these issues, it was agreed to give the green light to create MHE Enterprises Proprietary Limited. MHE Enterprises Proprietary Limited was successfully established in July 2012, with the first two positions being made available from the Aftercare on the 3rd of November 2014. Projections have indicated that MHE Enterprises Proprietary Limited is going to provide Stepping Stone Clubhouse with a significant portion of income related to these labour hire activities and recruitment function over the coming years. It is expected that MHE, along with the ancillary projects which are being undertaken from a social enterprise perspective, will provide Stepping Stone Clubhouse with 70% of their income by the year ended 30 June 2017. For not-for-profit organisations to take a positive step towards self-sufficiency and reduce reliance on government funding, a number of initial activities need to be explored. Firstly, to consider any functions which are currently being outsourced, could they be performed internally, as we've demonstrated with Stepping Stone Clubhouse. also need to explore ways of further commercialising this capability in order to generate revenue. The third step is to seek advice from the correct professionals to establish the correct structure to ensure that we preserve tax-exempt status where possible. Again, in performing a normal commercial function, we need to perform forecasting and due diligence activities as you would do with a normal mainstream business establishment. We then also need to ensure that the corporate governance standards required by the parent organisation are to be maintained. Hanrick Curran provides specialist advisory service to not-for-profit organisations. Please feel free to contact any of the presenters for further information on how we can assist your charities and associations.
Today I'm going to provide an overview of the state tax exemption available for charitable institutions. This exemption is available in most jurisdictions and is available in respect of payroll tax, land tax and stamp duty. I'll be talking through the requirements for registration in Queensland in particular, and also two key opportunities available for NFPs. In Queensland, there are 6 requirements for registration as a charitable institution, which I'll talk through. The first one is the institution's principal object or pursuit must fulfil a charitable object or promote the public good. While this sounds pretty broad, there is a specific definition, and it includes things like the relief of poverty, advancement of health, education, religion or culture, social or public welfare, advancement of natural environment, and other similar purposes beneficial to the general public. The only disqualifying purpose is that the institution's principal object of pursuit must not be one for leisure, recreation, social or sporting object or pursuit. This is unique to Queensland and is different in other states such as Victoria. Not only must the institution be carrying out a charitable purpose, it must be undertaking activities to achieve this. Importantly, when lodging an application, it's necessary to prove that they are actually undertaking these activities. In the past, evidence that we have provided to assist in this regard has been copies of submissions made by the charitable institution, reports on outcomes of particular programs that it undertakes, policy documents, and publications issued by the institution. The final 3 requirements for registration in Queensland are all determined by the constitution of the institution. The first one is the constitution must expressly state that the institution's income and property are to be used solely for promoting its object. In practice, this is one area where we have come across the largest amount of pushback from the Queensland Office of State Revenue. The Constitution must expressly state that no part of the income or property of the NFP can be provided or distributed in any way to any of the members of the institution. An example of an appropriate clause is provided on the slide for you below. Finally, the Constitution must also state that not only during its operation, but upon the dissolution of the institution, that its assets will be transferred to another registered charitable institution or an institution that the Commissioner is satisfied has a principal object of pursuit that is charitable or for the promotion of the public good. In practice, there are 2 key opportunities available for NFPs in this regard. First of all, to the extent that payroll tax, stamp duty or land tax has been paid by an entity that could be registered, there is a possibility to obtain a retrospective refund of the taxes paid for the previous 5 financial years. In addition to this, to the extent that the Constitution doesn't specifically answer to each of these requirements, there is an opportunity to appropriately amend the Constitution so that going forward the exemptions may be available.